As Connecticut Insurance Commissioner Tom Leonardi was outspoken about the role of regulation within the United States and internationally. Now, as a senior advisor at Evercore, the investment banking firm, he remains outspoken and provides his opinion about recent developments in regulation in this interview from the Global Insurance Forum at the United Nations in New York.
Well, I think the regulatory issues dealing with cyber, it's interesting because Ben Lawsky and I have for the last couple of years, and I think we might have even done videos on this program before about the importance of cyber. And I don't think there was a lot of traction on the regulatory side, at least within the insurance circles, until the Anthem attack occurred. And then I think it got people's attention, and maybe the pendulum swung a little bit. There was a little bit of grandstanding, a little bit of let's get on our soapbox. I think that's settled down now, and I think the regulatory community and the NAIC and the states in particular are recognizing that, number one, cybersecurity, unless a company has military-grade security, every company is at risk, and it's not a question of will we get hacked, it's when we will get hacked and how bad that will be. And how do you prepare companies and consumers to understand the implications and to protect consumers as much as possible given the risks that are associated with a cyber attack. So I think we're in a good place now, but I also think it's a very complex issue that, even the federal government recently got hacked. We have to make sure we don't demonize companies because they may have been the victim of a hack, but we also should expect the companies to do as much as they possibly can in that context. In terms of what I was trying to get at in my speech at the UN this morning, I think the major issue was the unintended consequences that can evolve from even the most well-meaning regulation. And one of the examples I used was market-consistent valuation, which has been pushed by a number of international regulators in the IIS Global Capital Standard, as well as part of Solvency II. My concern has always been that market-consistent valuation creates volatility within insurance company balance sheets and income statements, that insurers are buying long-term assets to match long-term liabilities, unlike banks where there's no maturity transformation. And as a result, what we're seeing is unintended consequences if you apply market-consistent valuation and require those companies to mark up and down on a quarterly basis, for example, the assets that they intend to hold for the long term. The result, in summary, is one, the lack of ability or willingness to invest long term, which includes government bonds potentially and certainly infrastructure. So from a policy standpoint, where emerging nations have significant infrastructure needs and even developed nations have repairing or replacing aging infrastructure, with insurers being a very large participant in that long-term infrastructure investment market, that creates a very significant negative. And then the other, and maybe as important, is the social network, the social safety net, if you will, of making it difficult for companies to offer the long-term security products that help to relieve local and state and national governments, which are having budget constraints, from having to fund the Social Security for all of its citizens. So I think that's one example where regulation, even though well-intended, can have significant negative impacts on policy issues for society. I know that the FSB and many other international bodies would like to have the U.S. system have one regulator. The FSB peer review from 2 years ago made it very clear that they don't like our national state-based system. The reality is it's not going to change in the next year, and it's not going to change in the next probably 50 years, as much as people might like that. I do think our system is one that's been proven, that has worked through bank crises, through financial crises, through depressions, through 2 world wars, and it's a system that works. So while it may have ways to be improved, the Solvency Modernization Initiative, for example, was a major step up and as a result of the financial crisis, risk-based capital in the early 90s. But the likelihood that we will have one regulator is very, very slim to none. Now, the Federal Reserve, in terms of that portion of the question, the Federal Reserve has responsibility under Dodd-Frank for the 4 systemic companies, well, the 3 systemic companies if you eliminate GE, but and also a number of bank holding companies, but 4 really large ones. And so for those 7 companies, the 3 SIFIs and the 4 large bank holding companies, the Fed is going to be coming up with a set of rules that it believes make sense. But it's not going to be looking to, in my view, expand its responsibilities or its footprint beyond what Dodd-Frank has given it. And in order for the Fed to be the global regulator of U.S. industry and supplant the states, I think is something the Fed hasn't asked for, Congress would not have an appetite for, nor would the states or the state legislatures or certainly the state regulators. I think the goals for regulators, first of all, number one is protect policyholders. That should be the number one issue for every regulator, and I know in the states it certainly is. Secondly, to create a set of rules that are clearly defined, where the industry knows what's expected of them and what they can and can't do, and then apply those rules uniformly and consistently. I think changing the rules in the middle of the stream, so to speak, is not a good thing. It creates uncertainty. Industry and capital markets don't like uncertainty. So I think that's really important. In terms of the more granular parts of regulation, I think from an NAIC standpoint, the states are looking to continue to pass principle-based reserving. Some states are still continuing to pass the Model Holding Company Act, which has significant improvements to our group's supervision. And I think that the need to focus on the captive issue and the concerns that have been expressed by folks like Superintendent Torti about regulatory arbitrage within our own system are very important for all of the industry as well as all regulators.
For more of our coverage of the Global Insurance Forum from New York, visit the RIN TV On Demand Library.